we recently looked at the kind of annuity that a 65-year-old in good health might receive. We looked 5 years ago at 2020, and the rate would have been around 4.6%. Now, today, September 2025, the rate for that kind of someone in a similar circumstance would be almost 8%.
Hello, everybody, and welcome back to the Personal Investor Podcast. I'm Ed Monk, and I'm joined today by my Fidelity colleague, Marianna Hunt, to talk about a way of funding retirement that used to be the go-to option for most people, but which has fallen out of fashion over the last decade or so. Over the past year, however, it has seen a dramatic comeback. We're talking, of course, about annuities. Why are retirees, once again, looking at them, and what is the smart way to blend them into your retirement plans? Before we get into it, could I please encourage you to subscribe to the channel, to like this video, to join the discussion in the comments if you wish. It really does help other people find the content, and it means that you'll get new content as it is released. That said, Marianna, welcome along. How are you?
I'm good, thanks. How are you, Ed?
I'm very well. I guess the first thing to clear off here is what exactly annuities are. They will sound very old-fashioned to me. What do they offer you? Give us annuities for beginners in 30 seconds.
Absolutely. So an annuity, when it comes to retirement, is essentially a steady stream of income. How it works is you give an insurer a pot of money and they guarantee to pay you a series of regular payments over a set period of time. Now, the one that most people will be most familiar with is called the lifetime annuity, and that's where the insurer guarantees to pay you those that series of income payments for the rest of your life, no matter how long you live. Now, the amount you receive via the annuity will depend on a number of factors. So the first one is the size of the pot that you give them. Naturally, bigger pot means bigger income.
There's a percentage rate, right?
Exactly.
And you get that back each year. Yeah.
Exactly. The second point, which I'm sure we'll cover later when we talk about where rates are, is the economic environment at the time that you take out the annuity. And the third point is the insurer will take into account various factors that give them an indication of your life expectancy. So things like your gender, your age, your medical record, where you live. And essentially, the longer the insurer expects you to live, the less you're going to get.
Yes. I mean, basically, these are what people can use their pension savings to or it's how they would turn those savings into income, basically,
Exactly.
or one of the methods at least. And I said that they used to be the go-to option. So let's do a bit of a history lesson here. Why was that the case? And what changed and when to make retirees look perhaps beyond annuities for their retirement income?
So it's exactly as you said. Previously, retirees were obliged to buy an annuity, but around 10 years ago, the government introduced something that was called pension freedoms, which essentially meant that you no longer had to buy an annuity. You could also access your pension in a more flexible way, which is known as drawdown. Now, actually, the obligation to buy an annuity disappeared a bit before this, but I think the big bang moment was pension freedoms. So with drawdown, essentially your pot of money remains invested and you can draw as much or as little income as you like from it. However, there is no guarantee with drawdown. The onus is very much on you to make sure your money lasts. Now, there are various kind of pros and cons to annuities versus drawdown, and the option that you go for will be entirely based on your personal circumstances, but I can quickly just run through some of those key pros and cons. So on the side of annuities, obviously you have the security of a guaranteed regular income. You don't get that with drawdown. However, you do get more flexibility. You have the benefit that your money remains invested in the stock market, so you still have the potential to benefit from stock market growth. With annuities, a lot of those policies won't keep pace with inflation. Now, that will depend on the type of annuity you have, of course. There are annuities that go up with inflation, but the rates that you get for those will be slightly worse. There are level annuities. Now, the payments that you get there will be fixed. So if prices go up, the value of your income will drop in real terms. And then finally, there are death benefits to consider. So with a number of annuities, if you die, those income payments simply stop. Now, again, there are types of annuities that will continue paying out after your death, whether that's a lump sum or regular payments. But again, the rates for those will be slightly worse. It works slightly differently with drawdown. So any unspent money in your pension via drawdown when you die can be passed on to your loved ones.
Very comprehensive. Well done, because there's a lot to cover there. So pension freedoms, we've actually covered it once or twice in different ways on the podcast before. This opening up of people's income choices. And we'll use the phrase drawdown for shorthand.
Yeah.
There's actually a couple of different methods you can use, right, for exactly how you take your money from investments. But the point is that it's a pot that you leave invested. We've looked at previously the returns that people got, in this period since pension freedoms, which was about 10 years ago, 2015 they came in. And by and large, it's hard to completely generalize, but by and large, actually, you would have been much better off in drawdown. Returns from markets have been really good. The stock market has been very good, but even in bonds, which have had a shaky period, you kind of would have been better off in drawdown. And the annuity market wasn't working very well for people back then, right? I mean, I was there covering that as a journalist at the time, and the big complaint was no one was properly shopping around for their annuity. They were getting whatever deal was being offered to them by their pension savings company. And so instead of kind of looking for the best, most competitive rate they could get, maybe based on ill health or what other, factors that might actually give them a better rate, they weren't doing that. So basically the competition wasn't really working in the market. And so the rates really weren't great back then. And for long periods, they've not been great. But something's been happening in the past year, hasn't it? That's made people reassess annuities.
Exactly. So as you say, for a long period, the rates weren't great. And that's because insurers underpin annuities with investments in long-term gilts. So that's UK government bonds. And for a long period, the returns of gilts were not brilliant. So the returns of annuities were not brilliant. However, in the past couple of years, gilt yields have been spiking, which means that the rates available via annuities have been spiking as well, and they're now at near decade highs. So if we look at an example, we recently looked at the kind of annuity that a 65-year-old in good health might receive. We looked 5 years ago at 2020, and the rate would have been around 4.6%. Now, today, September 2025, the rate for that kind of someone in a similar circumstance would be almost 8%. So that is a huge difference.
Yeah, and actually we're going to bring something up on screen, which if you're watching on YouTube, you'll be able to see. But if you're not, you'll have to just bear with us. But basically it shows what's happened to annuity rates going back quite a long way to the start of the 1990s. You can see annuity rates basically falling and falling and falling, and then rising in the past year or so, but we're also showing the 15-year gilt yield. Yeah. These are government bonds, 15-year government bonds essentially, and they're an asset that's often used to underpin annuities, and the rates often move in correlation, right?
Yes, although probably worth pointing out that these rates might not be around forever because the Bank of England is expected to cut rates over the next 12 months, and that should bring gilt yields down, which in turn should bring annuity rates down. Yes,
it's a complicated picture with bonds at the moment. We've been covering quite a lot on the podcast. Yeah, different things are happening in different parts of the bond market, but there are reasons to think that those rates might come down, and clearly lots of people have been attracted back to annuities. That's been showing in sales figures for annuities. At the start of 2024, annuity sales were almost back up to where they were before pension freedoms. And probably this year they're going to be even better because rates have just got better and better since then. In terms of the income that annuities pay, describe some of the rates there. They're going to compare to, in income terms, they're going to compare to whatever rate of withdrawals you take from a pot of investments. All sorts of discussion goes on as to the most appropriate levels. 4% is a long-standing, kind of quite a cautious, long-standing rule, but often people will aim higher than that, maybe 5%. Now, in terms of just the income part of it, annuities right now look more attractive than that, frankly. But the big attraction with drawdown or keeping your money invested, of course, is that you do keep it, don't you? And there was, and there still is, an advantage to having your money in a pension and in drawdown from an inheritance point of view.
Yes.
That's changing, but what's the situation there?
Exactly. So until now, if you accessed your pension via drawdown, any money that was unspent in the pension when you died could be passed on to your loved ones, and it could be passed on IHT free, so inheritance tax free. Now, the government has actually changed the situation here. So from April 2027, any unspent money in your pension that's been accessed via drawdown will be considered as part of your estate for inheritance tax purposes. Now, this could make people think a little bit more seriously about annuities because there's an allowance called gifting from surplus income. And what this essentially means is you can gift a potentially unlimited amount to your loved ones so long as you're doing it from your regular income, and making those regular payments doesn't mean that you have to sacrifice on your lifestyle. So the idea here is that potentially someone could take out an annuity and then use that income to give regular gifts to their loved ones, in the idea that you could kind of reduce your inheritance tax liability later down the line. Now, if someone was looking to do this, there are a couple of things they should be mindful of. Firstly, that they don't need that income later down the line. Secondly, are they giving up potentially quite valuable drawdown benefits? And thirdly, the fact that you do need to have quite careful record keeping to prove to HMRC that you followed all the rules correctly.
Yeah. You've been writing on this whole area in the past week or so, Marianna, and in particular, you were looking at ways in which retirees who might still want ultimately to have their money invested for all the reasons that we've kind of mentioned about why drawdown is attractive, but they might see the attraction right now in particular of annuities. What did you find out about the different approaches of introducing annuities into income plans?
So I think most people think of annuities versus drawdown as this either or approach. But actually, people often overlook the fact that there's a third option, which is to blend the two. And if done appropriately and in the right circumstances, this could potentially be a bit of a best of both worlds approach, because by combining the two, you can have the security of a guaranteed income that you get from an annuity, plus you're sort of insuring yourself against longevity risk because you've guaranteed this income for life. But you also have some of your money remaining invested in the stock market, benefit from stock market growth, and you have flexible access to that capital if you need it. So I spoke to our financial advice team and they said that they are seeing increasing interest in this blended approach, and that one thing people often look to do is to underpin their essential spending. So take out an annuity that covers your essential spending, and then you can access the rest of the capital flexibly via drawdown. And they said that you often see that when people do this and they've got the confidence that their essential spending is guaranteed, that they're actually comfortable taking a bit more risk with the rest of their investments in the hope of better returns. Now, whether that's right for you or not will be completely dependent on individual circumstances. And obviously health is something to bear in mind. So if, you've been told by a doctor that you don't have much longer to live, then probably an annuity isn't the best option. So it's very much kind of weighing up, your individual circumstances.
Yeah, and the timing of all these decisions, it's wrong to think that everyone has to hit a retirement date and then kind of set their income plans in stone for the rest of their life. Particularly with annuities, there can be great benefits to waiting. If the difference between buying at 65 and 75, the rates will just get better and better because essentially the insurance company, the annuities company, I should say, has got to work out how many years they're going to have to pay this thing for. And obviously, if there's fewer years left and you're older, you're going to get a better rate. One of the things in your work this week that really caught my eye was a particular way of using a particular type of annuity. And in the example, it was recreating income provided by the state pension, and actually led really to a way maybe of people being able to retire early or use annuities in a way that would see their income supported in the early years of retirement.
Exactly. And as you said, you can have different combinations of annuities and drawdown that work better for different periods of your life. It's not a once and done decision. So one of the strategies that our financial advice team have seen a lot of interest in recently has been in something called fixed term annuities. So this is essentially where you give to the annuity company a pot of money and they agree to pay you a regular guaranteed income over a fixed period of time. And at the end, you get a guaranteed maturity value back. So, for example, if you were retiring early at age 60 and you wanted to essentially replicate the income that the state pension would give you to bridge the gap between the age of 67 when you will receive the state pension, then you could take out one of these fixed term annuities for, say, 7 years, and you could bridge that gap. We actually looked at the rates available and how much it would cost someone. So for a 60-year-old at the moment, based on various assumptions, that would cost them around £500,000 to have that 7-year fixed term annuity with the state pension-like payment. But at the end of the 7 years, they would get back a guaranteed maturity value of £585,000. So £85,000 more than they gave the company in the first place.
Yeah, no, that really caught my eye. I mean, probably someone better at maths will be able to tell me exactly how good a deal that actually is. Seems like a really good deal. I mean, clearly you're tying that money up for that period.
Yes.
When it's in an annuity. So it's not there for you to spend. It's not there for you to generate an income in any other way, right? So that's obviously a big consideration.
Yeah.
Especially if the whole point of this exercise is to let you not have to work and provide an income for you. However, I do think it will be attractive to a lot of people to say, because people are getting a state pension at 67. Mine will be later than that. Yours might be even later than that, Marianna.
I'm sure.
Let's break it to you. But people still have quite firm ideas of retiring at 60 if they can.
Yeah.
A lot of people, and they'll be looking for that period where they need to bridge that gap until they get that state pension. That could be a really interesting way of doing it, because you're going to get. I mean, what's the rate on that? That must be.
You're testing our maths here.
It's pretty good. I think it's like 6% a year of income, and you get that sum back at the end of it, right? It seems like a pretty good deal.
And just to add to that, one point that I forgot to mention was we're assuming that the income you get over those 7 years goes up by 2.5% each year to kind of mimic that triple lock effect. Yeah.
Now, we're going to say that none of this is any kind of personalised advice. It's just an example that you picked upon.
Exactly.
But it's a really good advert, I think, for getting advice at that point in your life. And I've said this a bunch of times before, that in lots of areas of, I work in the area, right? So I don't actually think there's lots of things I can probably do myself in terms of financial planning, picking investments, some of the tax things, I can do that on my own. But the from my experience of seeing the pros do it, the point I'll definitely get financial advice is when you're planning retirement income, because they have all these methods and ways of blending them together that you're basically not going to be able to do unless you've got a kind of expert trained eye on it. And this is just one of those, right?
Definitely. And I said it before and I'll say it again, but it's all completely individual. And the benefit of speaking to a financial advisor is they can take in all of your individual circumstances and come up with entirely the best approach for you personally.
Indeed. Okay, well, Marianna, that is just about all the time we have for now. I will just remind you all that if you found this useful or interesting, to please subscribe to the channel. It means you'll get updated content as soon as it's released. Give us a like or share the episode. That really does help people find what we're doing here. That said, Marianna, thanks for joining me.
Thanks, Ed.